Zu uns gekommen hier am Fondsprofessionell-Kongress ist Katie Koch. Sie ist Co-Chefin der Fundamental Equity Gruppe von Goldman Sachs Asset Management. Katie, thanks for being with us here at the event. So, your presentation here at the Congress was titled "The End of the Beta Rally." So, what do we have to prepare for? Is it getting worse or is it getting better?
Thank you so much, and I'm very excited to be here in Germany. I want to start by saying I'm proud my family came from here, as you can tell from my last name, Koch, and I also met my husband in Frankfurt, so it's really good to be back in Germany. As it relates to the current market environment, very quickly, what I would say is that it is possible things might actually get worse. We're down 27% for U.S. markets, as an example. It is possible things may get worse before they get better for three quick reasons. The first is that rates may go up more than the market expects because of inflation. Second, from a valuation perspective, the last time the 10-year Treasury was at 3.5%, the S&P price to earnings multiple, or how much you have to pay for the earnings, was at 13 times, and we're currently at 16 times. So while things have gotten cheaper, they may get cheaper yet as rates go up. And then the third point would be that the retail investor hasn't yet capitulated or panicked, and that unfortunately does usually coincide with the bottom of the market. So those are some reasons to believe that things may get worse. All of that being said, we would encourage people to maintain investment because it's actually very difficult to time. And in fact, for our clients, we're actually putting money to work. And the way that we're doing that is we're doing it gradually to start here and acknowledge that valuations are attractive here, but to recognize that it could deteriorate, we're legging into the market. And I really think that that is the best, most sensible advice to give to people, because there really is no one that has proven skill of timing the entry point here repeatedly.
Especially technology stocks in particular have felt the downward trend in the markets, in the equity markets recently. This doesn't really seem to worry you. On the contrary, your message to investors, which sounds rather simple at first glance, is keep the faith. So what is the basis for your confidence at a time when central banks will no longer act as a support for the stock markets for well-known reasons?
The main reasons that we're constructive on technology, these companies may underperform near term if rates go up, particularly because they're growth oriented, but they don't need the central bank to work long term because they're actually just incredible franchises that are quite essential to the running of the global economy, which I'll come back to. I want to say, just very big picture, that the moment we have now is very unlike the tech bubble we had in 1999, where the drawdown of the NASDAQ, so the U.S. tech index, was over 70%. Back then, we actually had a technology problem in that we had a lot of dot-com companies before people were even really using the internet in that way. It didn't really explode until we got mobile, as an example. And so the hype got way ahead of where the actual companies were. Now, in 2022, actually, these are incredible businesses, and they're very essential. I use a word I used before. Very quickly, if you take software, most businesses do need their software subscription to run their business. There's a very famous quote from Robert Smith, who's the CEO of Vista, a venture and growth funds that does tech investing, where he says that software is better than first lien debt. And there's truth in that because people pay that software contract first. The second area would be cyber, which we know is very important for people to secure their data, and even more important in the current geopolitical environment. And then semis, which the content of semi use is going up dramatically. And everybody needs semis for pretty much the manufacturing of most things. But take electric vehicles here, which Germany is obviously a leader in. 1 out of every 3 cars sold is now an electric vehicle. And the semi content for those cars is 2x what it is for a combustible engine. And so those are just some quick examples to say that these businesses are essential businesses. And then the final point I would make is that you actually, if you're selective, can find businesses with cash on the balance sheet that can make it through this difficult economic period and that are generating free cash flow and that finally are actually trading at really compelling valuations. And so what we would say, the reason we're very optimistic here is that we have these incredible secular opportunities and a chance to get into them at very dislocated cyclical valuations. We meet management teams all over the world, and I have yet to meet a management team that tells me they're going to cut their tech spending. Actually, most people are going to continue to spend on tech. So this is a great time to continue to own or to buy into the innovation and technology space, which is going to continue to grow at very attractive valuations.
But the question is, how long will investors be willing to stand still in the face of a situation where a gorge, such as the so-called fear and greed index, has slipped to levels that we have not seen for a very long time?
Very sadly, investors actually usually do panic out at the wrong moment, particularly individual investors. And so I feel really passionately to try and make it different this time, that retail investors don't panic out and they stay invested. So I acknowledge the possibility that they may still panic because it is a difficult environment. But what I would say to those individual investors is that big institutions around the world are waiting for that moment to actually buy back into the market. So you don't want to be the person that other people are taking advantage of. And while it is very difficult, the best thing to do is to remain invested because you are likely to panic out at the wrong moment. And then additionally, you have to get back into the market. That can be very challenging to do at the right time. If you miss out on the best 15 trading days, you actually miss out on 22% of the returns over 10 years. So it's very difficult to time, and people should remain invested.
You were talking about your favorites in the market, but is there anything that you are deliberately avoiding?
So from a regional perspective, we're very positive on the U.S. and perhaps somewhat controversially on China, where we do see opportunity and believe that China will reopen and could be poised for a recovery. And then in places that we're avoiding, and maybe this won't make me very popular with your audience, but we're less positive on Europe right now. We do think it's facing greater issues because of its energy dependence and its demographics ultimately and growth potential. We do own assets in Europe, but we are very selective. So we own a concert company because it can perform in the face of a recession. People will still go to concerts. And we own some assets related to the climate transition, as an example, and also some companies listed in Europe that are selling to other parts of the world. But that's a place where we're more cautious.
Thank you very much for being with us. Thanks a lot.
Thank you for having me.